Okay. Good morning to all, and thank you for accepting our invitation for the launch of the 2024 Central Bank of Malta Annual Report. Apart from the reporting of its financial statements, as is customary, the bank's annual report also provides an analysis of economic and financial developments in Malta during 2024, together with an overview of the external environment within which the Maltese economy operates. It also provides an account of the activity that was undertaken by the business area of the bank, by each business area of the bank. During this morning, we will be delivering a presentation that is essentially segmented into four parts. In the first part, I will speak about monetary policy developments in the euro area. Then the bank's chief economist, Dr. Aaron Grek, will then highlight the main developments in the Maltese economy during 2024 and will also provide us with an outlook for this year and the next two. Then the Deputy Governor responsible for financial stability, Mr. Oliver Bonello, will provide us with an overview of the domestic banking sector, the main developments during last year. And finally, I will conclude by reporting the central bank's own key financial results for the financial year ending 31st December 2024. Okay, so I will start with the ECB's monetary policy. As you may be aware, the ECB's monetary policy basically focuses on one objective, that is inflation, price stability, which we define as the inflation of 2% over the medium term, which makes our life a bit less complicated than our Federal Reserve Bank counterparts who have also economic growth as their target. So as you may imagine, the Governing Council is very much focused on what is happening to inflation over the recent past, but also going forward as well, especially. And we have seen that inflation, after rising to very high levels in 2022, where in October basically peaked at over 10%, inflation in the euro area embarked on a steady downward path, but still remained very high, at least until 2023, which was at around 5.4%. This downward path continued in 2024, with inflation falling at 2.4%, which is also on average in line with what we experienced, as Dr. Grek will mention later on, during the last year. And basically over the last quarter, it has been hovering at around 2.2, 2.5%. From the chart, we can see also that the disinflation process, the good news about it is that it was spread across all components of the HICP, but mostly driven by food, which is the blue bar, and the non-energy industrial goods, which is the yellow bar. Services inflation also declined, but still remained elevated at around 4% because of the lagged response of wages to the rise in past inflation. And this, of course, wages usually affect most services inflation. Apart from the impact of wages, the persistence of services inflation was also driven by the influence of certain items like health and insurance, whose prices also tend to react with a delay to overall inflation developments. On the other hand, energy inflation continued to contribute to lower inflation, which is the gray bar, although its effect was rather small, and we could observe also some volatility, as is usually the case with energy across the year. The data up to March shows that inflation has moderated further to 2.2%, with services inflation now easing to 3.5%. And this has given the Governing Council increased confidence that wage inflation is slowing down, and these are largely being absorbed also through profits and thus avoiding risks of second-round effects on inflation. So now we turn a bit to the outlook for HICP inflation, and this can be seen from the chart. The various vintages of inflation projection exercises by the Eurosystem point consistently towards a further decline in inflation during 2025. This has been so far confirmed with the incoming data. However, the achievement of the inflation target from a monetary policy perspective needs to be sustainable over the medium term. And basically, the incoming data suggests that with every projection exercise, there is growing confidence that inflation remains on track to achieve the 2% target over the medium term. Indeed, given the recent significant appreciation of the euro, and the fall in energy prices during the past month, which we estimate overall in euro terms, it's around a drop of around 18%, which is quite significant. It may well be the case also that the 2% target is actually achieved earlier than suggested in the latest projections that were published in March by the ECB. The picture of declining inflation and settling sustainably at around 2% is also confirmed in the right chart, which refers to inflation excluding volatile items like food and energy. In March, this fell to 2.4%, and over the medium term, as you can see, it is expected to be at around 2% or even slightly below. The shaded area essentially shows the width of the range within which the range of projections have changed, and on average this has been limited to just 0.2%, which also suggests a great degree of confidence in the reliability of the projections, especially to incoming information such as fiscal policy announcements, wage negotiations, and revisions to the technical assumptions such as those relating to the exchange rate and international prices, energy prices. So the picture remains one where overall inflation is expected to stabilize at around 2%, while in the case of underlying inflation, this is expected to converge to 2% at a later date than overall inflation because, as I said before, there are the lagged effects of wage increases which affect HICPX with a lag. As can be seen from the left-hand side chart, the ECB continued to raise interest rates until September of 2023 and then paused until April of 2024. At the time, I recall that inflation projections in March had already been revised downwards, but because inflation then was still high and the economy was at that time expected to recover, most members of the Governing Council felt that it was not really the time to start reducing the restrictiveness of monetary policy. By June, inflation outcomes were broadly as expected, and the June projections showed that inflation was expected to move towards 2% in the medium term. And this gave confidence to the Governing Council to start reducing rates, especially since risks to economic growth were increasingly leaning to the downside, and financing conditions still remained restrictive on the market. Along 2024, this picture was reaffirmed, with inflation moving broadly on track, with projections and economic growth turning out to be weaker than expected, with projections to economic growth being revised downwards with one exercise after the other. And basically this signaled to the Governing Council that there are lower risks to price pressures from demand. And essentially this led to 6 successive 25 basis points cuts in interest rates, with the DFR declining from 4% at the end of 2023 to 3% by the end of that year, and to a further decline to 2.25% by late April, a couple of weeks ago. During the year, it was also decided that as from the 18th September, the spread between the DFR and the MRO would be reduced to to just 15 basis points from 50 basis points, while the spread between the MRO and the margin lending facility was kept unchanged at 25 basis points. As regards to the ECB's balance sheet, which is on the right-hand side of the slide, this continued to decline, basically because the targeted long-term refinancing operations that are part of the LTROs, which is the yellow area, were being fully repaid or matured by December. So basically the program on TLTROs has ended. Similarly, the securities held for monetary policy purposes, which is the blue area, declined by about 4.4 trillion, which declined further in 2025, and this partly reflected the decline in APP holdings as maturing securities were not replaced, while in the case of the pandemic emergency program, this basically transitioned from full to partial reinvestments in the second half of 2024, and then reinvestments were ended completely at the end of the year. So the reductions in securities and repayment of TLTROs were then partly offset by increases in other assets, which is the red area, which most notably involves increase in holdings of gold by the ECB. So now we turn a bit on how the DFR, the changes in DFR transmitted into the markets. And we start off with the sovereign yields. And basically the cuts in the DFR were transmitted immediately and smoothly to money market rates, and were also reflected to an extent in long-term government bond yields, where towards the end of 2023, markets had already started to anticipate cuts in interest rates by the ECB. Long-term yields were around 40 basis points lower by the end of the year compared to May, although there was some reversal in the final quarter of the year. However, one could also observe some heterogeneity across countries, as French yields were affected by political instability with the budget approved only in February of this year, while German yields were lower compared to end 23. However, overall, one could say that bond spreads remained relatively stable in the euro area. In Malta, long-term yields decreased by around 46 basis points between May, that is before the first rate cut, and December of last year, averaging at around 3.07%. However, as you probably know, in Q1 of 2025, long-term interest rates increased by about 50 basis points, particularly in January and in March, with the rise in January largely reflecting the increase in US rates as the introduction of tariffs and increased inflation expectations decreased prospects of further cuts by the Federal Reserve Bank, while the increase in March, the increase which we observed in March was largely triggered by the announcement of additional fiscal spending on infrastructure and defense in the euro area, particularly by Germany. So that led to increased long-term yields. If we look at deposit rates, one can see from the charts that the rate cuts are slowly starting to affect deposit rates in the euro area, both with respect to deposits held by households and also by businesses. In fact, interest rates on fixed-term deposits between May of 2024, that is before the rate cuts, and February 2025 declined by 115 basis points for non-financial corporates and by 90 basis points for households, with the ECB cutting rates during that period by around 125 basis points. As with the hiking cycle, the transmission of monetary policy in Malta, when interest rates started to decline, was also weaker relative to the euro area, with interest on fixed-term deposits for NFCs falling by about 67 basis points, while for households, these dropped by just 23 basis points. As can be seen also from the chart, the level of deposit rates for both households and NFCs between Malta and the euro area have tended to converge, and these interest rates for Malta are now at around the middle of the range for euro area countries. Turning to lending rates with respect to these, basically these decreased slightly in the euro area for both households and NFCs. In the case of Malta, mortgage rates to households also decreased slightly, but remain somewhat lower than in the euro area, and they basically stand at around the bottom of the range. In the case of lending to businesses, interest rates in the euro area declined by more, with lending rates in Malta being currently slightly higher than the euro area average, though lending rates in Malta are now at around also in the middle of the range across the euro area. In my final slide, I turn a bit now to the outlook for monetary policy in the euro area. So the latest information on inflation continues to show that the disinflation process is pretty much on track, and it is expected that the 2% target is reached on a sustained basis, perhaps even earlier, as I said before, than had been projected in March, if the current strength of the euro persists and international energy prices remain at around the current levels. Services inflation is also on a downward path, standing at 3.5% in March, the lowest rate in 3 years, and various wage indicators point towards further moderation in wage growth as pressures are easing. Moreover, profits have been buffering the impact of wage growth on inflation, and this gives us confidence that the 2% target can be reached also sustainably. With the direct immediate impact of tariffs, while the direct immediate impact of tariffs may be inflationary, especially with retaliation. However, the adverse effects on business and consumer confidence make them deflationary in the medium and long term, especially in the case of Europe. In the case of the US, the situation is a bit different. There it's more likely that there could be stagflation because the tariffs are directly impacting consumers in the US, and therefore inflation in the US, and also affecting negatively the growth. So basically, in the medium and long term, we expect demand to be weaker, and also there could be some materialization of financial stability risks from negative financial markets. This is especially the case for the US, where the negative impact on economic growth could have impacts on the banking sector. However, to these downside risks, there are also some upward risks to inflation. For example, the transition to a green economy and fiscal stimulus by some of the larger euro area countries could provide risks to some inflation, and this would go to some extent maybe in the opposite direction of the impact of the tariffs and their effect on confidence. So we are currently at a point where we are experiencing not only high uncertainty, but I would say very high unpredictability, because things change sometimes from one day to the next, which makes the situation very difficult to assess. So this makes it even more critical for the Governing Council to continue to remain on its policy of being data dependent and follow a meeting by meeting approach without committing to any particular rate path. But as things stand, as I said, we are quite confident that inflation is pretty much on track. Now the next meeting will be in June, where we will have a new set of projections for the euro area, and we will see there how these projections will change from the previous ones. my expectation is that probably growth will be revised downwards, and inflation, at least in the short term, could also be revised downwards because, as I mentioned, there are marked changes to the exchange rate and energy prices. So probably in June, I expect to see the reconfirmation that the 2% target will remain on track, but we'll have to wait and see. And if that is the case, there could be some room for further easing. With that, I now turn to Dr. Gregg, who will give us an overview about the developments that occurred in 2024 in the Maltese economy and also an outlook for this year and the next two.
Thank you, Acting Governor. The Maltese economy continued to perform very strongly during 2024, and the divergence with the rest of the euro area remained quite stark, as you can see in the chart, even if economic activity in Malta in 2024 moderated somewhat compared to 2023. That said, real GDP in Malta rose by 6%. It was lower than the 6.8% a year earlier. However, this rate of growth is quite above the historical average for the Maltese economy and more than 6 times the slight growth, the very slight growth observed in the euro area that the Acting Governor was speaking about before. The outperformance of the Maltese economy has been going on now for quite some time, and in fact, in 2024, the Maltese GDP level was about a third higher than it had been in 2019, that is, before the pandemic. On the other hand, if one looks at the euro area GDP, this was just 5% higher than it was before the pandemic. So basically, the euro area, economically speaking, is where Malta was in 2021, so about 3 years before. When one looks at the headline figures, economic growth in Malta last year was mostly supported by domestic demand. Private consumption added about 2.7 percentage points to GDP growth, so about nearly half of growth. And this was on account of a very broad-based increase across all categories of private consumption. However, the strongest increase in absolute terms was in what you would call leisure spending, which is spending on restaurants and accommodation services. Government consumption also accelerated last year due to higher growth in spending on intermediate consumption and compensation of employees. And in total, it added about 1.2 percentage points to annual GDP growth. One of the reasons why there was this input from government consumption was that there was the signing of quite substantial collective agreements for those working in the public, education, and health sectors, which were quite generous by historical standards. That said, net exports also contributed positively to growth, albeit to a smaller extent than in previous years. Now, if one, however, adjusts for the import content of the various expenditure components, the situation is a bit more balanced, as the difference between the contribution of domestic demand and exports becomes less significant. In particular, last year we had, again, a very strong tourism activity, which was one of the main causes behind the increase in net exports. Now, looking at sectoral contributions, this is even more evident because it shows that services remain the main driver of economic expansion, and a lot of the increase came from the sector that comprises wholesale and retail trade and the accommodation and food services, which to a certain extent are driven by tourism activity. However, if one looks also at the sectors that comprise professional, scientific, administrative and related activities, as well as that related to public administration, education and health, there was also a very positive contribution to real GDP growth. The manufacturing sector also had a positive contribution to growth last year, and for the first time in 3 years, the construction sector had a positive contribution. In the previous 2 years, construction had been negatively contributing to growth. One major change in the economic situation compared to previous years was that our labor force grew at a more moderate pace. And this mainly reflected the fact that the expansion in the foreign workforce decelerated quite sharply. This was probably due to the introduction of labor regulations, particularly for the temping agencies, so the agencies that provide temporary workers to companies. In fact, overall employment last year grew by 5.4%, whereas in the previous year it had grown by 6.7%. And if one looks particularly at the stock of foreign workers, the percentage growth last year was nearly half of what it had been the previous year. These developments therefore led to an improvement in labor productivity, which was quite significant and contrasted with what was happening in previous years. And the other thing that these data suggest is that the moves to regulate the inflow of foreign workers do not seem, at least for now, to be dampening economic growth noticeably. So the economy is continuing to grow with a lesser increase in the labor input. So that said, even though the employment rate growth slowed down, when one looks at the unemployment rate, this continued to fall and has now reached a new historical record minimum, as it averaged about 3.1% in 2024, whereas the previous year it had been 3.5%. Unemployment in Malta remained marginally below half what it is in the euro area. So even there, the labor market gives indications that it continues to tighten. The job vacancy rate, in fact, in Malta continued to increase marginally, that's true. But however, the fact that unemployment declined and the job vacancy rate increased meant that the labor tightness, the imbalance between labor demand and labor supply in Malta continued to rise. And our indicator for labor tightness is now at a historical high, and this corroborates survey evidence from companies that continue to say that they are facing labor shortages. At the current juncture, even if one assumes that all unemployed have the skill sets that would be required by the labor market, we would not have enough unemployed to fill all our job vacancies in absolute terms. And this is a first for our economy. However, despite the very tight labor market and the increase in labor market tightness, which resulted in an increase in wages and an acceleration of wages last year, which then contributed to labor-intensive services prices to increase. However, overall inflation dropped very substantially in Malta, from about 3.7% in January to 1.8% by the end of the year. This was one of the most pronounced declines in inflation experienced in several years. To a certain extent, this reflected the fact that supply conditions abroad and also import prices normalized substantially, and this reflected the discussion, the points that were made by the acting governor about what happened in the euro area. At the same time, there were domestic developments that also contributed to help to dampen somewhat. For instance, food inflation. For example, there was the government Stabilitas scheme, and in fact, food inflation, thanks to this scheme and also to developments in foreign prices, we saw food inflation halving to 2.4% from about 5.6% in 2023. Inflation in Malta ended up below that in the euro area. One reason was because of these domestic developments, also the fact that government continued to subsidize fuel prices and energy prices. The moderation in price pressures, as measured by the HICP, are also visible in the bank's core inflation measure and the retail price index, and especially the retail price index is not that much affected by services consumed by tourists. And as I said, one of the main reasons why we had an increase in a certain level of HICP inflation last year was because our tourism sector was doing very well, and this led to higher restaurant and hotel prices. In fact, one focuses on the domestic component only, the RPI, the rate of inflation there was 1.7%, which was very much lower than the 5.1% that we had a year earlier. Turning to the fiscal side, government expenditure, as I said, grew considerably in 2024, mainly due to the signing of major public sector collective agreements. However, there was also a significant increase in the generosity of social security benefits, and also there were considerable one-off capital transfers, mostly related to the setting up of a new airline. The government ended up purchasing a number of aircraft for this new airline, and this boosted government expenditure, of course, in a one-off nature, because these purchases will not reoccur in the current year. However, despite this increase in government expenditure, we had a very large rise in government revenue that reflected the fast pace of economic growth combined with improvements in tax collection methods, and therefore government revenue ended up growing by far more than expenditure, and this led to the deficit narrowing again. And to a certain extent, this narrowing was faster than anticipated by government itself, though the central bank, we had forecast that the deficit would be falling to 3.7%. Another thing that can be noticed from the charts is that the government debt to GDP ratio fell once again, and this reflected the fact that GDP growth is so fast that it is reversing the effect that we are having to borrow more to finance the deficit. A debt sustainability analysis that is published within the annual report shows that even if one assumes significant economic shocks, therefore lesser growth than what we project, it is very highly unlikely that public debt in Malta could breach the Maastricht benchmark of 60% over the medium term. Looking forwards, in terms of outlook, we expect the Maltese economy to continue to grow. However, the growth rates will be lower than in previous years. The growth rate that we're expecting for 2025 is of 4%, which remains above the potential growth rate of the Maltese economy. However, in the subsequent 2 years, we expect growth to somewhat dip below the potential growth rate of the Maltese economy, and mainly this, we believe, will be the reaction to lower labor supply, as we expect that the labor market regulations that are going to be introduced by government will continue to dampen the flow of foreign workers, and therefore there will be less labor, and firms will have to adjust to this new reality, and this will, of course, lead to a temporary adjustment where they would be growing by less than the potential. Growth, as you see, in 2027 would be of around 3.3%. Domestic demand will remain the main driver of growth throughout this period, although we expect net exports to also have a positive contribution. Private consumption growth is set to, however, moderate compared to previous years, as domestic demand from consumers is normalizing from the very high rates of growth that we had in previous years. Disposable income growth, however, will sustain private consumption, particularly in 2025, when there is going to be an improvement in disposable income because of the widening of the income tax bands, which will give a permanent increase in income to certain consumer groups. And also we are noticing, especially after the collective agreement signed by government workers, that wage growth is picking up across even the private sector. At the same time, real government consumption should start to ease in terms of growth. However, in later years, it should pick up again as government introduces even more measures. And on one of the years where we're expecting some pickup will be, of course, government investment, as more projects financed by EU funds start to gather steam. And also private investment, we're expecting it to be positively growing over this period. In the immediate years, however, there will be some dampening of net exports. One reason is because of tourism, which has been growing at double-digit rates, and we are expecting tourism now to start to moderate in terms of growth, and also the fact that there is an uncertain international environment, particularly related to global trade policy. This should have some impact on our exports, and therefore, as you can see, the contribution of net exports is not going to be major in the coming years. Demand for labor will remain sustained because of the high rates of growth of GDP. However, as I said before, the changes in the regulations and labor market regulations should lead to an easing of the inflows that we had in recent years. And on the other hand, we expect productivity to increase by more than it had in the past decade. However, the combination of all of this should mean that the unemployment rate should dampen a bit further and fall to around 3%. However, this is very close. It's a bit lower than our natural rate of unemployment, and therefore we don't expect the unemployment rate to continue falling below the 3%. In terms of inflation, in fact, as the acting government was saying before, the forecast is for euro area inflation to continue to moderate, and this, of course, will have an impact on our own inflation rate. And our inflation rate, we expect it to converge to the 2% target already by next year. And this year it should just be slightly above the 2% target at 2.1%. The easing of inflation will continue to reflect a decline in food prices, industrial goods, and also probably to services inflation. Energy inflation in our projections are assumed to remain at the level of 0 because we assume that government is going to continue to maintain the subsidies. In terms of the bank's fiscal forecasts, these are basically showing that the deficit should fall below the 3% mark already by next year, and then the improvement should continue to go on even in 2027, where we expect the government balance to be of just 2.6%. And this mainly reflects the fact that inflation mitigation measures, such as the energy subsidies, little by little are dropping in terms of the size in relation to GDP, and also the path of energy prices is not assumed to deviate from there to be an increase in energy prices requiring further assistance. Also, as I said, there were certain one-off impacts on government spending, such as the restructuring of the national airline, that we're not expecting to have an impact in the coming years. However, in terms of the general government debt to GDP, we expect this to increase slightly over the coming years because the path of economic growth is a bit lower than in previous years, and therefore the deficit will start to reflect in a higher debt ratio. Turning to risks, to our projections, we believe that this year the balance of risks to activity, to GDP, are broadly balanced, and downside risks largely emanate from possible adverse effects on foreign demand related to geopolitical tensions, particularly any new US tariffs beyond those included in our baseline, such, for example, any possible tariffs on semiconductors, which up to now are not included in the US tariffs, and also the possibility of retaliatory measures on the part of other blocs that would dampen overall GDP growth in the world. A prolongation of the current elevated economic and geopolitical uncertainty could also dampen activity, particularly because Malta is very dependent on a free global trading system. On the other hand, while we expect the labor market to continue to tighten and for labor inflows to decline going forward, it could be that the labor market exhibits even stronger dynamics than what we expect, and this, of course, would affect both employment and wages, and that would boost domestic demand by more than what we are projecting in our baseline. On the other hand, with inflation, there are upside risks because there could be supply-side bottlenecks emanating from these ongoing geopolitical conflicts and also higher input costs arising from changes in the global trade policy. However, as the acting governor was saying, this is only a short-term effect because in the long term, these risks would lead to, would materialize into lower economic growth, and this would dampen inflation coming from abroad. And therefore, while there is some upside risk, there is also a downside risk that these tariffs would end up leading to a lower growth rate of the global economy and a lower price level. On the fiscal side, on the other hand, risks are mostly tilted to the downside, so the deficit increasing, and this mainly reflects the likelihood of possible slippages in current expenditure and also additional increases in pensions and wages in the outer years of our projection. Thank you.
To Deputy Governor Connell on the banking sector developments.
Okay, mic is on. I will be going over the developments within the banking sector, starting with some indicators and closing with some policy implications. The banks operate with ample capital and liquidity buffers, as can be seen on the left-hand panel. Banks remained well capitalized with an increase in the total capital ratio by both the core domestic banks and the overall banking system. At 25%, the total capital ratio of the core domestic banks by far exceeded the euro area average of around 20%. And this could be seen being the red line against the gray bar. The right-hand panel shows that the banking sector enjoys ample liquidity buffers. Both the liquidity coverage ratio and the net stable funding ratio well exceed the minimum regulatory requirement of 100%. The LCR for the core banks stood at 367%, while the NSFR stood at 184%. And both ratios continue to outperform the euro area averages of 163% and 127% respectively. And this demonstrates that the local banks are highly liquid. Bank profitability and asset quality remain supportive. Last year, the overall banking sector's profitability declined, mainly due to developments in the branches of foreign banks and a slight decline in the profits by the non-core domestic banks. In contrast, however, the core domestic banks recorded a record 10% increase in pre-tax profits. Overall, the banking sector's return on assets fell from 1.3 to 0.7. However, this is almost nearly to the euro area average of 0.73%, with the return on assets of the core banks improving to over 1%, and this is depicted by the red line. The right-hand panel shows the positive development in asset quality, which improved further last year. The NPL ratio of the banking sector declined to 1.9% from 2.2%, while the coverage ratio rose to 58%. The core domestic banks saw their NPL ratio fall from 2.5% in 2023 to 2.1% in 2024. With the resident mortgage NPL ratio falling to 1.1% and the corporate loans NPL ratio dropping to 4.5%. And this is indeed below the ECB threshold NPL guidance of 5%. So the overall loan quality improved with increased stage 1, while stage 2 and 3 loans decreasing significantly. Credit dynamics remain buoyant. Resident lending grew by 6.5% last year, but less than the 8.3% seen in 2023, mainly due to a slowdown in lending to non-financial corporates, which rose by 1.6%, however. As shown in the right-hand panel, this slowdown in NFC lending was driven by a contraction in lending in sectors not tied to the property market. Since sectors such as transportation, energy, and administrative services saw a drop in credit, while growth in ICT and professional services also decreased. These are depicted by the red bars. In contrast, and these are the teal bars, lending to construction, real estate, and accommodation remained strong, together increasing by around 9%. The left-hand panel also shows that mortgage lending growth accelerated to 9.2% last year, up from 7.9% in 2023. This growth was supported by a property price growth of 6.4%. The combined mortgages and property-linked lending, which includes construction, real estate, and accommodation, make up around 73% of total resident credit. Consumer credit, though a small portion of the overall lending portfolio, continued to grow, supported by demand for green products at preferential rates. Within these credit dynamics, we see diverging leverage trends, given that NFC debt to total assets is decreasing, while household debt to assets is increasing. On the left-hand panel, non-financial corporate debt increased by 7.7% over 2023, reaching 157% of GDP. But much of this reflects intra-group loans, with such funding accounting for half of total NFC debt. In fact, consolidated NFC debt stood at a more contained rate of 65.7% of GDP, and lower than euro area average of 67.4%, so indicating a more contained risk profile. NFC leverage measured as debt relative to total assets stood at 24%, and this is depicted by the red line in the chart, and continues to remain below the euro average of 25.5%. Meanwhile, household debt grew by 7.1%, but as a share of GDP, it decreased slightly to around 49%, reflecting stronger growth in gross domestic product relative to household debt. This is below the euro area average of around 52%. But household leverage rose marginally to 23.6%, which is almost that of the euro area average. That said, net financial wealth of household rose by 5.3% to stand around 149% of GDP. And nearly half of household assets are in liquid form, largely in cash and deposits. And this suggests, of course, strong liquidity buffers. Now turning to policy implications, macroprudential tools are introduced to enhance banks' resilience and increasing their loss absorption capacity, and be in a better position to withstand any adverse shocks. In 2023, a sectoral systemic risk buffer was introduced, specifically targeting residential real estate exposures. Given the strong growth in property-related lending, the bank is considering extending the sectoral systemic risk buffer to cover all the other real estate-related exposures. To conclude, as we have seen, the banking sector is supported by ample capital and liquidity buffers and is profitable with strong asset quality. Residential real estate risks remain relevant and continue to be addressed through the current sectoral systemic risk buffer and the borrower-based measures. However, potential new vulnerabilities are emerging in other real estate-related sectors, particularly, as I mentioned, the construction, real estate, and accommodation. This may warrant a broader policy response. In the light of this, the Central Bank of Malta is currently working on a policy proposal to extend the existing sectoral systemic risk buffer to cover all real estate-related activities. In fact, a consultation exercise with the banks has already been initiated. I thank you for your attention, and with this, I pass the floor to Acting Governor DeMarco to continue with his final presentation. Thank you.
Thank you, Oliver. We'll go on to the final couple of slides, and basically here I will be reporting the financial results of the central bank itself. So we'll start off a bit with the developments in the balance sheet of the bank, and the balance sheet of the bank last year contracted by around 645 million to just over around 10 billion. This decline, basically in the balance sheet, largely reflected a drop in other customer balances and collateralized in our deposits. And basically this essentially reflected the narrowing of the spread between the DFR and the MRO, which made repo operations no longer attractive for the bank, and the bank, in fact, withdrew from such activity towards the end of last year. Deposits by credit institutions also continued to decline. They declined by around 94 million, essentially reflecting drawdowns by banks to increase holdings of fixed income financial assets in anticipation of a less restrictive monetary policy stance. And also government deposits with the central bank declined by around 166 million, as it seemed that the government preferred to increase its deposits with local credit institutions rather than the central bank. These developments, of course, led to a lower balance on the target, which declined by about 1.3 billion, while monetary policy-related assets also decreased by 123 million as a result of the winding down of the APP through maturities. These declines were partly offset by an increase in assets under management of the bank, up by 944 million, basically to improve our revenue flows, especially at a time when yields were expected to have peaked. So I now turn to the profit and loss account, essentially. As with other NCBs and the ECB itself over 2022 and 2023, the bank's profitability was hit by the Eurosystem monetary policy stance, which of course remains our primary mandate and is irrespective of our own profitability. Interest rates on deposit liabilities of central banks had climbed markedly and swiftly, while the return on its stock of assets evolves only very slowly, and this led to significant hits in the bank's P&L account in respect of the net income from monetary policy instruments. In 2022 and 2023, this resulted in a hit of about almost 40 million, which reduced our stock of provisions that we built over the past 12 years to around 89 million. In 2024, monetary income hit our P&L with almost 50 million, as you can see from the slide. However, our investment strategies paid off as net interest income improved by 22% or 14 million, and our active trading and financial assets saw an increase of just over 8 million in realized gains. This more than offset the 2.5 million or 7.5% increase in our operating expenses. This was mostly driven this year by the new collective agreement and also further investment in digitalization of the bank. So as a result, during 2024, the bank, I would say, proudly say, was one of the exceptions within the Eurosystem, whereby it succeeded to turn around its financial performance, recording a small profit of just over 5 million, which the board of the bank decided to transfer to provisions to rebuild them after two years of dipping into our provisions. And for this, I would like to thank the bank staff for their continued valuable support and dedication in achieving such a positive result in such difficult circumstances. As you may have seen, all the major NCBs, including the ECB, have recorded very big losses during the past year. So this brings us to the end to our presentation, and I now open the floor to questions that you may have for us. Thank you. volunteers. Can it? No volunteer?
Decline in the non-performing exposures with the mortgage book, which is less than 1% on average in the banks. Is there a consideration not to include that in the systemic risk buffer? Because the trend has been stable for many, many years now.
Yeah, if you want, Dr. Oliver will reply.
About this. Well, actually, this is a very good question. Because currently, as I mentioned, the non-performing loans are quite low. But again, the decision to extend the sectoral systemic risk buffer is based on a broader forward-looking assessment rather than a current one. Actually, the sectoral systemic risk buffer aims to proactively strengthen the bank's resilience against systemic risks that can build, of course, over time, such as rising prices, leveraging, structural imbalances. However, our work is based on key indicators coming out from aggregate credit gap analysis and this, we call it CSRI, the cyclical systemic risk indicators, which are not currently indicating a medium risk and slightly going to the upside. Again, when we go to sectoral analysis, we find that the construction, real estate, and the accommodation sectors are showing increasing cyclical risks. And mainly this is the reason why we are considering, we have not implemented, as I said, it's not decided yet, but we are in discussions with the banks as well. But this is the reason, rather than going to the NPLs, it's true that they are very low, but our analysis, our models are showing a medium risk. And if you go to the sectoral analysis, you find that accommodation constructions are growing. And then you have the concentration risk.
Yes, I think, Carol, yes.
Thank you. First of all, thank you for the very interesting presentation. It's really good to see, even obviously our interest here is for the banking sector, and not only we're seeing increases in the economy, and naturally the banking sector is responding to that and also reacting positively from a prudential point of view, which is always good to know, not only as a sector but also for us as consumers and direct interested parties of banks. I'd like to build a bit on the question raised by our chair, Kenneth Farrugia, relating to the systemic risk buffer. I hear what Mr. Bonello has said from the possible increased risk profile. I've also read what the IMF has flagged in this report, in this respect, in the Article 4 mission they have had, which is, okay, good to see that there is a further prudential measure which is being contemplated. Great, but the sector would also appreciate that the situation would be a bit more equitable, in the sense that, as the authorities know, both the central bank and MFSA, MBA has been striving to have a more effective and equitable process when the liquidation of corporate collateral is actually triggered off. And as the authorities know, that is only triggered off after a painstaking process of trying to remediate, a process of forbearance, a process of restructuring, and it's only at the extreme that banks would have to take the nuclear option, so to say, to go to the courts to get paid. But as we all know, the local legal system is very much biased in favor of the debtor. And as a sector, we are a bit concerned that if one addresses capital buffers, and perhaps rightly so. We're not challenging that, to cater for a possible rise in prudential risks there. It would be only equitable to address also the deficiencies which banks recognize are there, and as the authorities know, the process is not, as I said before, one which is an immediate process. The process often takes, not often, it takes years. Sometimes, regrettably, it takes decades, believe it or not. So this is not a question per se, but rather a comment on perhaps the authorities' view on taking into account a more equitable view of what hits our banks, not only on the risks, but also on the possibility of getting their money paid back. Thank you.
As you know, Carol, there have been discussions admittedly for a prolonged period of time on this matter, and my understanding is that the discussions are still ongoing. This is not something which depends on the central bank or the MFSA for that matter. We are very much sympathetic to your plea. I mean, we would like also to see more efficient resolution of non-performing loans, and in this case, in the execution of collateral. It's a delicate issue, but certainly we are much sympathetic to that. But I mean, with respect to the contemplation of extending the coverage of the systemic risk buffer, this is a bit of a different issue. I mean, we have been seeing banks increasingly focus on lending to the real estate sector, and to some extent this is also helping, let's put it this way, to support also the market, the property market. And in fact, we still see inflation of around 6% in the property market for quite some time now. And certainly this of course increases risks to banks when you have concentration or a larger concentration into a particular sector. The banks, having said that, I mean, the banks are very well capitalized. I mean, it's not that we are concerned about banks, performance. I mean, the banks are very well capitalized. The non-performing loans have decreased, even despite these deficiencies, perhaps in our legal system, to very low levels. Even also for non-financial corporates, we've seen quite a big reduction from what we had some years ago. So that is a very good sign that as the economy has been growing, also the business actors are doing relatively well and are able to also repay the banks their loans. So I mean, we still have very good trust in the banks and their capabilities and to withstand shocks. But certainly we must also reaffirm that we cannot lower the guard. There are temptations, and I understand the banks sometimes put pressures on the authorities. I'm not speaking here about perhaps the local banks, but as you know, the international environment is one where countries on the other side of the Atlantic are trying to reduce regulation, and this comes at very big risks, which I think in Europe we are not willing to take. The great financial crisis may now be almost forgotten by everyone, but we've seen a lot of shocks in the last few years, and we've seen the banks, especially in Europe, remaining very solid. So that regulation that was enacted has reaped fruit, and certainly we need to keep watch of risks that are lurking in the bad episodes arise. So I think independent of the issue that you raised, which is a very, very, very valid point, no question about that, and with which we support. But I think we need to also continue to be on the lookout for risks that might be around the corner. Hopefully they don't materialize, but we always have to be prepared. Alfred.
Sandra, I'll put my question in the international context. Basically, the simple question is, how worried or how is the ECB preparing itself for what is happening on the other side of the Atlantic? We know that the executive on the other side has very much doubts about whether to support the independence of the central bank. And that could have a major effect on the exchange rate, which obviously will rebound back to whatever projections you have spoken today. We have already seen very abnormal short-term moves in the exchange rate between the euro and the dollar, which affects us. I think until some time ago, 1 month ago or 6 weeks ago, we were at 105. Today we even touched the 1.15. And in that context, there was a speech last week at the IMF in a conference organized by the G30 by Kevin Walsh, who everybody seems to assume will be the next chairman of the Federal Reserve, where to everybody's astonishment, he came up with the policy that the central bank should not be data-driven, but the central bank should have a policy and stick to it. And, the abnormal measures taken when there were abnormal situations, he criticized them substantially. So these sort of policies mixed together with influence, which puts in doubt the independence of the central bank on the other side, and new policies which could adopt a new governor, a new president of the Federal Reserve, will have major impact on the operations of the ECB. So my question is, are you worried about it? Are you doing anything with that, or should we just pray?
No, it's a very good question, and it's a very topical issue. First of all, I immediately say that yes, we are very worried about what's happening in the United States. And I would say there are three main concerns, particular concerns. One, of course, it relates to international free trade. We understand to some extent the concerns of the US that sometimes certain countries might not be playing a fair game. But I think the actions that were taken were a bit stretched too far. And also, I would say, rather in an amateur way as well. So the concern of international trade, or reduction in international trade, free trade, is very, very much of a concern. It's not that probably, there will be a reduction in globalization, but the way things are developing, it could be that there would be more regionalization. But certainly that is one of the concerns. The second concern of the ECB, and I would say of Europeans, is also the lack of respect of rule of law in the United States. We've seen decisions by the courts which the administration refuses to accept and to respect. I think that is another concern for Europe as well. And of course, as you mentioned, the third concern relates to the independence of the central bank. We know, from empirical evidence that inflation is let's put it this way, the goal of price stability is better achieved with independent central banks than with central banks who may lean towards the whims of governments. So those are certainly pretty much concerns on the other side of the pond. And I was also in those IMF meetings last week, and in his statement, the present president of the Fed pretty much reaffirmed his intention, to act without any influence from government. But of course, one could see that the situation is very not normal in the US at the moment, unfortunately. As regards to Europe, I think this, to some extent, presents some opportunities as well. I mean, I would have never thought in my lifetime to see the US dollar, which is always has been a safe haven currency, and that confidence in the US dollar has been shaken. I still think it will remain a reserve currency, no question about that. But there are questions around it now, given the policies of the present administration. So we've seen investors withdrawing from US assets, and that is an opportunity also for Europe. We have an opportunity also to present to markets as being a predictable jurisdiction, despite all the disagreements between the euro area governments and what have you. But I think it's, at least from a monetary policy perspective, certainly Europe has become more predictable, and that is something which is to our advantage and which investors highly appreciate. It is also a wake-up call for us to be not only more autonomous in terms of military dependency from the US, that is one of the issues that has arose over the past months, but also now I think there is a greater realization that also in terms of payment systems we need to be more independent and autonomous, and rely less on US firms in this regard. And I think, as you know, we have this project on the digital euro, and I think some of the politicians who were quite skeptic about this project, and they had various conspiracy theories to try to stifle it, are now coming around, and it seems that there is now more support for the project to be pushed forward. So I think these are all opportunities. And let's face it, Europe usually big decisions occurs during times of crisis. And one hopes that we are in a situation of crisis. I mean, the US has clearly created a crisis to the world order, and let's hope that this situation this crisis is not wasted, and we manage to push forward certain items which have been long on the agenda of Europe, like the Savings and Investment Union and the Banking Union. And I can assure you that there are strong pushes there to get things moving, to make Europe a more powerful bloc. As I said, it's very sad to see the US in such a situation, because a strong United States usually gives rise to a stronger world economy, and as you have seen, the IMF has downgraded the forecast for the global economy and practically to all countries, which is not a pleasant outcome. But I think this if you want to call it, that there is a silver lining to this cloud, it has pushed us also as Europe to try to become more efficient, also to become more autonomous. Yep. I don't know if anybody has any other questions. So if not, maybe we can close here. And I once again thank you very much for accepting our invitations and being here, and hope that our presentations were of benefit to you as well. Thank you.